Seekers. We are here on another Friday, videoing our fourth episode to What's the Mortgage Deal. I'm Josh Thelen. Again, episode 4, we are going to be covering conventional and FHA financing. There are basically 4 types of loan programs that 98% of folks are going to fall into. Conventional, Fannie and Freddie, FHA financing, USDA, and VA. So I thought today I would tackle some similarities and differences between conventional financing and FHA. And then next week we'll do a video on the attributes, similarities, differences between USDA and the VA, Better Administration Loans. So let's get right into it. Appreciate you guys joining me here today and following. Try to do this as quickly as possible. I could talk for a half hour again, just like FICO scores, on the attributes and details of these 2 loan programs, but I'm going to try to give you some of the highlights of the differences and then some of the highlights that I thought were important for people to know that they might actually not know and I thought were beneficial. So here we go. Conventional, Fannie and Freddie. So you'll hear Fannie and Freddie. Those are not government agencies. These are basically middlemen that came up with standards for conventional loans. These standards tightened a great deal after the 2008 situation that occurred where the real estate market basically dropped out. So what Fannie and Freddie are basically government-sponsored programs where guidelines were put together. They're basically middlemen that package these conventional loans and then sell them to investors on the outside world, whether insurance companies, hedge funds, just large investors in general. They are not government-sponsored or government-backed loans. That's a very important feature that a lot of people get confused. Ginnie Mae is actually a government entity that backs 3 loan programs, and it's insured. The Ginnie Mae insures these 3 loan programs. It is FHA, VA, and the USDA, which is the Rural Development Loan. Again, today we're going to cover these 2. But again, so Fannie and Freddie are not government agencies. They are government-sponsored guidelines. So the government basically sponsored these guidelines, talked and worked with these investors to figure out the guidelines that go into these conventional Fannie and Freddie loans. And FHA is actually a government-insured loan sponsored and insured by HUD, which is the Housing and Urban Development Organization, that if there ever is a default on an FHA loan, the government will step in and pay that investor, whoever financed that loan, pay that investor for those funds if there's ever a default. So what does that mean? That basically means that for conventional loans, there are no bailouts. If there is a default on that loan, then that lender loses that money. So what are we obviously going to assume the restrictions are going to be a little bit more on a conventional loan than on an FHA loan, where that investor knows if something happens to this borrower and they default on the loan, they're going to get their money back. So these guidelines are a little more loose. We'll talk about them now. And Fannie and Freddie are a little stricter, a little tighter because of that default risk. So here we go. Let's talk about 4 main categories here. Actually, it's 5, sorry. LTV, loan amount, FICO score, DTI, and PMI. These are the things that, as a loan officer, will receive calls and have major questions in regarding these 5 categories. So I figured I'd cover the differences between the 2 groups today with you, and then hit some highlights when we're done. So here we go. LTV, the difference between FHA and conventional. Conventional has, for the most part, and there are specific programs where this could change, and if you have further questions or you want to know about a 3% down conventional loan because they are out there, there's higher FICO score requirements for them, just give me a call, message me, and we can discuss those. I'm going to give you the generic basic guidelines for the 2 programs. Okay, conventional needs 5% down to finance a loan. As a buyer, you need to come to the table with typically 5 to 20% down payment funds for the house. On an FHA loan, 3.5% is what's needed. On a 1 to 4 unit property, 3.5%, it can actually be your down payment funds, which is kind of amazing. Again, the same. It's actually the same for conventional as well. LTV 1 to 4 units is going to be 5%, but the FICO requirement is going to be higher on the 3 and 4 units than it is for the single family or 2 family for conventional. So again, 5% conventional loans, 3.5% FHA. A cool side note, we have a program out right now, came out in the beginning of February, that is a 1.5% down FHA program. Lender paid 2%. So the buyer or the borrower comes up with 1.5% of the down payment, and us as the lender will pay the other 2% at closing. Again, any questions or you want some additional details on that, feel free to reach out to me. Minimum loan amounts, or maximum loan amounts I should say, on a conventional side has now changed to 400 in this area. Actually, they don't have area restrictions for conventional. This is a national number, and it's $453,100 for a single family loan amount maximum for conventional. FHA is based on your county and the territory you're in, and in the Hamden County, that number is $299,000. Sorry, I almost forgot it for a second. That is a single family residence. The loan amount does increase for a 2 unit, 3 unit, and a 4 unit. Anything above 4 unit, and you're talking about a commercial property, 4 units I believe are $579,000. So there is an increase with each unit. FICO requirements on a conventional loan, the lenders, investors are going to want to see a 640 minimum FICO score. We talked about FICO scores last week. Won't get into them now. It's basically Fair Isaac Company. There's 3 repositories. That middle FICO score has to be at least a 640 in order to qualify for Fannie or Freddie loans. With FHA loans, there is actually no minimum FICO score. They actually set the standard at 500 and up. But lenders, such as Top Flight Financial and other lenders in the industry, they have what's called lender overlays. So each lender will have their minimum FICO score for FHA loans that they will allow. Ours here is a 580 minimum middle FICO score in order to qualify for that FHA loan. Okay, debt to income ratio. That is the amount of money you have coming in each month divided by the liabilities that are showing up on your credit report. Conventional debt to income ratio maximum is going to be 50%. Back end debt to income ratio. So they don't want to see your gross income, your liabilities divided by your gross income. They don't want to see that number, or they won't allow that number to be over 50%. On an FHA loan, obviously you can tell I'm using green for the better, for the better figure, and the red for the lower figure. Comparing the 2 loan programs is 57% debt to income ratio. So again, you can see that FHA more flexible when it comes to down payment funds right off the bat, as well as the debt to income ratios. Okay, PMI. A lot of people have questions about private mortgage insurance. We could probably do our own video explaining exactly what that is. But that is a mortgage insurance that is paid by the borrower in case the loan goes into default. The PMI company will cover a portion of the debt that was in default. So with a conventional loan, it's calculated very differently than an FHA loan. And with an FHA loan, there's also an upfront MIP, mortgage insurance premium, that is put on the front end, or actually the back end of a mortgage loan, that's basically put into the loan amount, so it's financeable, and then it also has a monthly payment associated to it as well. So let me give you an example. On a $200,000 loan, PMI in a conventional loan with a 680 FICO score, okay, is going to be, again, 680 FICO score, a 200K loan. You are going to have a rate factor for PMI at 1.05%. So you take 1.05%, move it to a decimal, it's 0.0105, multiply that by your 200,000 loan amount, and you are going to get an amount of, I wrote it down, it's going to be $2,160 divided by 12. So your monthly payment is actually going to be $180 for your MI. Okay? Again, conventional loans, that MI is due if you have less than 20% equity in the home. So if you're putting less than 20% down, you will have a sliding scale of MI. This is based on 5% and a 680 FICO score. That's what your factor would be. The better your credit score is, the slightly lower that factor moves down and the lower that MI payment will be. On the FHA side, as I mentioned, there's a upfront MIP, mortgage insurance premium. That's calculated by taking the $200,000 and multiplying it by 2.25% of the loan amount now. So again, 2.25% is 0.0225. Okay, that number equals 2160 divided by, actually no, we're doing upfront. So that actually is 4,000, sorry, apologize. That is like $4,500. That is going to be the amount, $4,500, that is added to the $200,000 loan amount. So the borrower would actually finance $204,500. They would also have a monthly mortgage insurance premium by putting 3.5% down. That rate factor is going to be 0.85%, which as a decimal is 0.085. So you multiply that number, 0.805, by 200,000, you get your amount. That's 2160. 2160 divided by 12 to get your monthly payment equals, I believe it's 141.67. So you can see 141.67. The MI payment's going to be slightly lower than the conventional side, but conventional will disappear once you have 79% or 21% equity in your home. You can apply to have that MI taken off of your loan amount or your loan payment. That goes away. With FHA, your MI, PMI never goes away. By the way, those terms are interchangeable, PMI and MI. Again, FHA will never go away. No matter what loan to value you have on your loan, you're always going to pay that MI. That's why a lot of people will get an FHA loan. They'll either refinance out of that once they have equity built in the property, and they will try to refinance into a conventional loan where they no longer have MI. So thank you very much for listening in today. We appreciate any of your comments and your following of What's the Mortgage Deal, and we'll catch you next week. Peace.